That exclusive chat now. I spoke with Matt King, global market strategist at Citi, on the sidelines of the India Investor Conference 2023, and began by asking Matt the outlook on inflation and how hawkish a Fed essentially will be. Is it possible that we get a bit of a Goldilocks kind of scenario, not too high inflation and a mildly okayish Fed as well? Listen in.
On the one hand, I think that I'm optimistic about inflation coming down, but the way I think about inflation is different from how the central banks think about it. They're focused on the persistent element, the services inflation, the wage growth, and that basically leaves them feeling they need to do more with the risk of holding rates too high for too long. And so to my mind, it's not really Goldilocks. It's just this mismatch between how they think about it and why I think about it. It may just justify, let's say, some further rally in the long end of bond markets, but it leaves the front ends potentially vulnerable to that more hawkish policy, and it leaves risk assets like credit and equities also more vulnerable to that hawkish policy.
Right. So, Matt, you're saying that, if I'm understanding you correctly, if they were to do a lot more, that would be a mistake?
Basically, because of the lags in the system, yes. And not only if they were to do a lot more, but even maintaining these levels of rates for an extended period, I think risks being a mistake. So the way central banks think assumes that rate changes feed through almost directly into levels of inflation. Their concern is that inflation in advanced economies is that inflation is still high. Real rates or real short rates are only just entering tight territory, and we're very worried about the persistence of inflation, about de-anchoring, and therefore, as I say, even as headline inflation starts to come down, they're focused on whatever they see as the lingering component, the sticky parts, the services inflation, the wage growth. All the things I look at in terms of money growth, they don't look at all. And when I look at, and therefore they assume there's sort of momentum behind the private sector, and that this momentum risks turning into persistent inflation. Everything I look at for advanced economies shows all of these monetary aggregates going in exactly the wrong direction. And a lot of the reason for that is that the surge in money growth, which I think drove asset prices and drove inflation, unlike history, it didn't come from the private sector. It didn't come from you and me borrowing because rates were cheap. It came from the fiscal stimulus in people's bank accounts. It came from the QE that had already been turned off, basically, even before the rate hike started. And now the central banks are carrying on with the rate hikes, even as the money growth numbers are deteriorating. So yes, temporarily, people are getting excited about Goldilocks. To my mind, the risks are that the lags in the system means that this collapse in money growth still hasn't made its way through. And on the one hand, that's good news in terms of inflation coming down, but it's not enough to make the central banks go back to easing, and that in turn adds up to this risk of over-tightening.
So when markets are pricing in around a 25-30 basis point rate cut by the Fed in the last part of this year, are they getting it right, in your opinion?
I can only imagine that happening if we have let's put it this way, there is a big inconsistency between that and the whole inversion of the yield curve and the indications of recession, and then what we're pricing into credit and especially what we're pricing into equities. I can imagine the bond market being right, but only if there is a huge deterioration in the economy, a huge deterioration or fall in inflation levels. In general, the hurdle for the central banks going back to easing is way larger than it was in 2019 when they were worried about deflation risks relative to now when they're worried about persistent inflation. And basically that creates the risk that in the near term we've priced in too much of that easing, but more than anything that credit and equities end up being vulnerable as the easing that they're hoping for turns out not to happen, especially with equities at these elevated levels.
Matt, you look at sort of global central bank liquidity very closely. Give us the big numbers. What was it at, pre-COVID? How much did it get to at the peak? Where are we now? And where are we headed?
This gets complicated, especially in the details. Let me give you the summary. In general, what I find is almost exactly the opposite of what the central banks tell you. They look at the size of the balance sheets, the levels of reserves. I look at They think once it's been announced, it should be priced in, I find it's only as the flows of liquidity hit markets or are withdrawn from markets that we seem capable of pricing it in. They look at the impact through rates. I look at the impact directly in credit and equities. And basically what I see is that $1 trillion change in liquidity from the central banks over the last decade corresponds relatively directly to 10% on or off equities. So far, so straightforward. And indeed, on the most obvious measure of central bank liquidity, the securities on their balance sheets, they're planning on draining a bit more than $1 trillion of liquidity this year. And so my instinctive starting point is to think, oh, that's another minus 10% or so on equities. The complicated bit is some of the extra technicals which also have an impact on reserves and I think are ultimately what drives markets. Some of those have been supportive over the last few weeks, especially from Japan and from China, and are part of why markets have been doing better. There is a story where in principle those could continue to be supportive all through this year, especially at the Fed. I'm not fully convinced about that story.
What happens once we get through this phase where the Fed gets to pushing rates up to wherever they're comfortable with and holds them, but eventually a year down the line, you think we will go back to an era of very low interest rates, which everyone got very used to, or you think that is very tough? How do you think about that?
This is a huge and complicated debate. I am probably in a minority by thinking that we do go back to those very low levels of rates, at least temporarily. The people who think that we are likely to have more persistent inflation and higher rates tend to be emphasizing factors like deglobalization. They say the shortfall in inflation previously was because of globalization, and now under deglobalization, maybe that's running in reverse. The trouble I have with that is that it sounds plausible, but I don't think it fits the data. What to me explains most of the previous disinflation is technology, and scalable technology in particular. What every firm wants to invest in is intellectual property, is branding, is software, is doing more and generating more profits, but with fewer employees and even with less capital. And to my mind, even as we get a rotation towards things like green energy, it's that lack of desire to borrow, which I see at a global level. It's that which I think has kept things like term premium down and kept rates down. And it's that lack of private sector money growth, which I'm right, will eventually mean that the central banks get forced back into easing and that we can come back to those low rates. The main threat I see to that is on the political side. If we re-elect populist politicians at a global level, and they push through time for easier fiscal policy and easier monetary policy, and there is a strong historical precedent for that, and kind of public sector debt pushes up interest rates, then that can turn things around. But just temporarily, we've seen it in the UK. The bond market really didn't like it, and I think other people will be hesitant to go down that route, but that would be the longer term risk to my mind. But it's all about this balance between technology on the one hand and then globalization, and people don't really have a clear view of which of the two is dominant.
All right, that is the macro picture, but let's slip into a quick break. Lots of stocks in focus, so don't go anywhere. We'll be back with the list of top 10 stocks in just minutes from now. Stay with us.